Wouldn't it be nice if you could buy into an investment that goes up in value, pays you money every single month, and every year pays you even more money on a monthly basis? I mean, that's basically what every investor is after in the first place, or at least should be, but where can you go about finding an investment such as this one in the first place? Well, that's actually what we're gonna be talking about in today's video, so make sure to get comfy wherever you are and get ready to be knowledged, if that's even a word. Hey, what's going on everyone? I hope you're all having an awesome day. My name's Griffin and I know just how much you guys enjoy when I make stock pick videos. So in today's video, we're actually gonna be diving into the top 3 Canadian Dividend Aristocrat stocks to add to your portfolio in 2020 for some juicy dividends as well as share appreciation. Wait, hold up. Dividend Aristocrat? Yup, the image of a curly-headed dude from the 1700s also pops into my head every single time I think of the word aristocrat, but today we're not talking about that type of aristocrat. We're actually going to be talking about companies who have been consistently raising their dividend payouts for a minimum of 5 years, as well as having a market cap above $300 million at the time of the year-end review when the S&P, so Standard & Poor's, conducts their year-end review to create these indexes. At this point though, you might be wondering, 5 consecutive years, it seems like a lot. Is that a lot? Really, what's the deal with this? Well, to be honest, 5 years could seem like a lot, but think of it this way. To be considered a dividend aristocrat down in the United States, a company has to be consistently raising their dividends for a minimum of 25 years, so way longer than in Canada. But the thing is, if we had that same criteria up here in Canada, there wouldn't be all that much selection at all. And so for this reason, Standard & Poor's will consider a Canadian company to be a dividend aristocrat if they've been raising their dividends consecutively for 5 years with a maximum of 2 consecutive years of dividend stagnation, so keeping the dividend distribution stagnant. Here's the rub though, a dividend increase can be considered anything above 1 penny per share, meaning that a dividend increase of only 1 cent can allow a company to qualify for a dividend increase in a given year. So if a company increases their dividend by 1 cent for 5 consecutive years, that technically would allow them to be on the Canadian Dividend Aristocrat list. For this reason, being considered a Canadian Dividend Aristocrat is great and all, but it's also really important to take this list with a grain of salt and then also take into consideration other factors such as, for example, the dividend payout ratio, as well as dividend growth rate, and pretty much just the overall financials of the company. If you're sitting there watching the video right now thinking to yourself, like, what is a dividend growth rate and what is a dividend payout ratio? Well, don't worry, we're going to be talking about those more in detail when we specifically look at the 3 dividend stocks later on in the video. But as a viewer, I really want you to understand exactly what these terms are before we move any further, so that you understand what's going on. Starting with the dividend payout ratio here, this is a percentage of the company's net income in a given year that they're redistributing back to shareholders in the form of a dividend. For example, if a company had a net income of $50 and they're paying out $25 in dividends back to their shareholders, that would be a 50% dividend payout ratio. In general, a company that has a dividend payout ratio ranging anywhere in between 35 to about 55% is going to be considered a healthy payout ratio from a dividend investor's point of view, because this demonstrates that a company who's able to pay out about half of their earnings back as dividends is A, well established in its industry, and then B, is also going to be a company that still has significant net income left over at the end of the year after paying out their dividends to utilize for future expansion and growth of the company, which in turn is going to be even better for us as dividend investors, because most likely they're going to be able to continue raising payouts as well as continue just distributing more dividends. Now to quickly cover the dividend growth rate, this is actually a percentage of growth in dividends from one year to the next. So for example, if a company started with a 50-cent dividend in year 1 and then in year 2 they raised their dividend by 5 cents, bringing the dividend to 55 cents, well, that represents a 10% dividend growth rate for that period of time. So taking all of those factors and those metrics into account when you're assessing a dividend stock, you should be able to boil down your search to a handful of different stocks that are going to be advantageous for your portfolio. I'm going to recycle the same joke as last video here. I know I'm not original, but apparently I have a bunch of free time on my hands because I went through every single Canadian stock currently considered a Canadian Dividend Aristocrat in order to save you time and energy, and you can find all of these these on my blog post, where you're not only going to find the 3 stocks that we're going to be speaking about in today's video, but also every single other Canadian dividend aristocrat that you're able to filter by dividend yield, market cap, as well as dividend payout ratio, and a bunch of other factors. So if that's of interest to you, make sure to check it out. Okay, so obviously there's more than only 3 great stocks on the entire Canadian dividend aristocrat list, but for one video, I couldn't go over like 25 great options, so I boiled it down to 3 really good options that are spread out across a variety of different industries, so that if you do decide to purchase these dividend stocks, you're somewhat diversified in your holdings. And by the way here, if after watching today's video, you're thinking to yourself, hey, I really enjoyed this Aristocrat stock pick video, then leave a comment down below letting me know that you enjoyed it, and I'll most likely make a part 2. So let's get right into the Aristocrat stock picks then. There are currently roughly 82 dividend aristocrats in Canada spread across our 10 major industries, with the highest concentration of these aristocrats in the financial sector, which isn't all that surprising, and then the second most highest concentration is in the energy sector, which again isn't all that surprising considering the fact that these 2 sectors are really notorious for having high dividends, especially in Canada. The first Canadian dividend aristocrat on today's list is in the consumer goods sector actually, and it is Canadian Tire Corp, also known under the ticker symbol CTC.A, and currently trades at a share value of roughly $142. This is a company that I'm sure you're all extremely familiar with in terms of being a customer. They have a wide variety of products ranging from car parts to home supplies, toys, and pretty much everything else in between. But as a dividend aristocrat, it's also a really great option, starting with the fact that they've been consistently raising their dividends for a period of 8 consecutive years, with a dividend growth rate of about 20.1% over the past 5 years as an average, which is really great to see for us dividend investors. Canadian Tire is an industry-leading Canadian retailer with a market cap of roughly $8.8 billion at the time of filming today's video, with steady increases in both net income as well as revenue over the past 5 years. Finally, the company has a dividend yield sitting right around 3.2%, and with this, a dividend payout ratio of only 38%, which, as we saw earlier in the video, is a great figure. This is a healthy payout ratio, and it means that over the coming years, Canadian Tire is in a position to not only continue paying out dividends, but also raising them over time. Moving on now to the second stock on today's list, we're shifting on over into the industrial sector with a company that operates in transportation and trucking logistics all across North America. I'm speaking here about TFI International Inc., also known under the ticker symbol TFII, which currently trades at roughly $44 with a market cap of right around $3.6 billion. The current dividend yield of TFII is sitting right around 2.3%, and the company has been consistently raising their dividends now for 8 consecutive years, with an average dividend growth rate of roughly 10%, leaving us now with a dividend payout ratio of only 26%. This low dividend payout ratio basically indicates that not only does the company have a lot of net income left over for future growth and expansion of their operations, but it also indicates that the dividend growth rate could significantly increase over the coming years. Finally, the company's financials are also quite attractive for investors, having steady increases in revenues year after year, and net income is also following that same pattern, leaving TFII now with a PE ratio of 12 and an earnings per share of about 3.6. If you're looking for a dividend aristocrat that's in good financial shape for share growth as well as dividend growth that's in the industrial sector, then TFII might be a great option for you. Moving on now to the third and final dividend aristocrat on today's list. This is a company that operates in the financial sector, and I guarantee you that every single one of you watching has heard of this company before. I'm speaking about Scotiabank, also known under the ticker symbol BNS on the Toronto Stock Exchange. Now, why did I pick Scotiabank over some of the other large Canadian banks? Well, truth be told, pretty much all the top Canadian banks are actually dividend aristocrats, and I actually own most of them in my portfolio anyways, but I chose Scotiabank over the other Canadian banks for this particular video, mostly due to the fact that they have a higher than average EPS at around 6.8 0.8, as well as a higher than average dividend yield at just below 5%. And in addition to those figures, Scotiabank also has a dividend payout ratio of only 54%, which, as we already know, is great. And with that, the dividend growth rate over the past 5 years has been at an average of 7%. Scotiabank is overall a great financial stock to buy and hold in your dividend stock portfolio for both share appreciation as well as continued dividend increases over the coming years. So with everything that we mentioned in today's video, what is your opinion on Dividend Aristocrats? Is this something that you take into account when you're looking at a new investment, or what are some other metrics that you personally take into account when you're looking for a great solid investment? I'd honestly love to know all of that, so leave a comment down below if you want to share your own opinion. And while you're at it, what did you think of the 3 stocks that we just covered? If you're interested in learning more about investing in the stock market, investing in dividend stocks, real estate, and a bunch of other financial topics, then consider subscribing to the channel. And by the way, have you ever heard of what a REIT is? If the answer to that question was no, I have no idea what a REIT is, then click the video right here. You're going to learn all about what a REIT is and how it can benefit you and your portfolio. So on that note, thanks for watching today's video, and I'll see you soon.